Well, we turn now to commodities. They are higher today, but last week, of course, it was everything we were talking about. Silver and oil led the way to a $99 billion market value loss. Goldman Sachs, which predicted the plunge, now sees a possible recovery, and our next guest agrees. Spencer Patton is founder and chief investment officer at Steel Vine Investments, an option-selling hedge fund which invests almost exclusively in commodities, and he joins us now from Nashville, Tennessee. Spencer, great to have you on the show again. Thanks for joining us on this Monday.
Thank you very much for having me, Lisa.
So let me ask you about last week. I mean, you have an option-selling hedge fund. Is that kind of volatility a good or bad thing for you?
You know, it's good to have a little bit of volatility, but not an excessive amount. Essentially, what you're looking for is just enough volatility where you get opportunity by causing a little bit of panic, some people selling when maybe they should have been buying, and it opens up the door to be able to buy commodities that have really maybe pulled back too quickly.
Now, you like silver, but last week we were hearing from a number of experts that said there had already been too much speculation. Then we got some new margin requirements. Why is silver going to go higher from here? It is higher on the day, of course.
Right. So silver has, the fundamental reason behind silver has not changed at all. It's had a great run up. And it went very, very quickly. And anytime you have those speculative booms and busts, you generally see in bull markets rapid advances, sharp corrections, and then a pretty rapid recovery. We've seen gold already recover. It's getting within a couple percent of the highs of where it was at. And silver will probably be the same way, as we see a cheaper alternative to people that don't want to put out $1,500 or $1,600 per ounce of gold. They have an alternative of $35 or $40 per ounce of silver.
Spencer, one quick question. We got 10 seconds. We have to go to break, and then we're going to talk to you a little bit more after that. But what about gold? It's back above the $1,500 level. Where do you see it by the end of the year?
I think it'll be at $1,750 to $1,800. We
left off, you know, we were talking about silver and gold, but you're actually more bullish on sort of the grain, softer commodities, Spencer.
That's exactly right. I think that there's some great fundamental stories going on. Just what you're talking about with the flood in the Mississippi Delta, there are some great reasons to go out and look at investing in corn, soybeans especially, and wheat to some extent as well.
Are you still bullish on coffee?
You know, coffee is such an interesting story. I think that coffee has elements that could see volatility, especially over the next 2 months, because we're going into winter in Brazil when you have a dangerous period where you could have a freeze. And if you get a freeze, you already have a tight coffee situation that could see coffee prices spike 20 or 25% just on a threat of a freeze. But outside of that happening, I'm not all that bullish on coffee prices. I think it's one of the weakest of the soft commodities.
Spencer, let me get your insight into exchange-traded funds and the impact that they've actually had on how commodities trade. So many people are looking for ways to get exposure, and it used to be you'd have to buy gold in bulk, you'll have to buy gold bars, and few investors could actually trade options. So I want to take a look. Right. There's an interesting chart we have here that sort of illustrates the difference between exchange-traded commodities and those that aren't, and we see a much more downward selling pressure. I'm not sure if we have it actually, but there's much more downward selling pressure on those exchange-traded commodities like silver and gold than the others, and mostly those tend to look like coal. So what's your perspective on that?
Yeah, there's a great data point with silver. Silver has fallen 35% just over the last week and a half. And silver on Thursday of last week traded more ounces than was mined in all of 2010 worldwide. So the silver ETF, SLV, had more ounces traded than all was harvested and mined in 2010. And that volatility, the access that it shows that the public can come in and trade silver is really reflecting the demand that is out there for both speculating upside and downside. It's amazing how ETFs have just come over and dominated a market that really needed some additional liquidity.
Now explain that then in the context of your fund and the strategy you employ. How do you separate out the fundamental versus the technical forces in any market?
Right, so that's always the challenge that we have. One thing that you have to look at is you have to decide where is the supply coming from silver and where is the demand coming from. And silver has a great fundamental story, especially with electronics, is in every iPhone that you have and every piece of electronic, there's a little piece of silver inside, and that's universal worldwide. And once you use up silver, there's no replacing it. And so it has a great fundamental story where gold, there's always going to be gold. You can't really utilize and destroy gold, where once you use silver, it's gone. So there's this really nice long-term story that silver is used both as an industrial metal and as a store of value as a precious metal.
All right, we have to end there, Spencer. Unfortunately, your great insight you always give us. Thanks so much. That was Spencer Patton of Steel Vine Investments.